Welcome to the Deep Dive. We're here to shortcut you to the insights that matter from complex sources.
That's right.
And today we're digging into the recent Sensus Healthcare first quarter 2025 financial results conference call.
Yep, we've been through the numbers, the management commentary.
So our mission really is just to unpack what they discussed, pull out those key nuggets so you understand the main story quickly.
And it's an interesting one because the Q1 headline numbers, well, they might look like a step back.
They certainly do on the surface.
But the story management is telling is quite different. It's about deliberate investment, laying groundwork for future growth, especially around a potentially big shift in their business model.
Okay, let's get into that. Because, looking just at the top line for Q1 2025, it was definitely down year over year.
It was. Revenue came in at $8.3 million.
$8.3 million. And compare that to Q1 2024.
That was $10.7 million, so a noticeable drop.
And I guess that drop hit the bottom line pretty hard.
Oh, yeah, straight through. They reported a net loss of $2.6 million for the quarter.
Wow, okay. Which is what, per share?
16 cents per share.
Right. And just a contrast, Q1 last year was profitable, wasn't it?
It was. They had net income then of $2.3 million or 14 cents per diluted share. So quite a swing.
A really stark contrast. And what about adjusted EBITDA? That's a number people often look at.
Right, stripping out some of the noise. Yeah. It was negative $2.5 million this quarter.
Negative $2.5 million compared to...
a positive $3 million a year ago. So again, big difference.
Okay, so the surface picture. Lower sales, significant loss. But you said management framed this as strategic investment. What was their main explanation?
Well, they basically pointed to two key things. First, lower unit sales to their largest customer during the quarter.
Okay, that makes sense. And second?
Significantly higher operating expenses. But, and this is the key part of their narrative, these higher costs weren't, accidental runaways.
Right.
They are presented as deliberate strategic investments, putting money into sales, marketing, R&D, initiatives they believe will drive much stronger growth later this year and beyond.
Got it. So, spending now for gains later. That's the pitch.
That's the pitch.
All right, let's dig into that spending then. Go inside the numbers a bit. Where did those dollars actually go, and what are these big initiatives they highlighted? What about below the revenue line, like gross profit?
Sure. So gross profit was $4.4 million.
Okay.
Which gives them a gross margin of 52%. They did note this reflected the lower sales volume, but also some higher service costs mixed in there.
52% margin. All right. And the big story, as you mentioned, was operating expenses, OPEX. Where did we see the jumps?
Pretty much across the board, but tied to specific things. Let's start with G&A, general and administrative.
Okay.
That rose to $2.2 million. Last year, it was $1.6 million.
So up about $600K. Why?
They linked it to professional fees and compensation costs, but they did flag that some of those Q1 costs were sort of unique one-off things.
Ah, okay. So maybe not a permanent increase.
Exactly. They expect the ongoing quarterly spend, the run rate, to settle back down to around $1.8 million going forward.
Okay, $1.8 million run rate for G&A. What about sales and marketing? That feels like a place they'd be investing if they're pushing something new.
And they were. Big jump there. $2.2 million this quarter.
Compared to?
Just $1.3 million in Q1 last year.
Wow, almost double. And the reason?
Directly tied, they said,
right,
to participating in major industry events. Conferences, trade shows, getting the word out, building that pipeline.
Makes sense. Is that level of spend the new normal?
They indicated probably not. Like G&A, it sounds like it'll be a bit lumpy depending on event schedules. They projected the run rate there would actually return closer to last year's levels, around $1.3 million per quarter.
Okay, so Q1 was heavy on events. And the last big OPEX category, R&D, crucial for a med device company.
And this saw the biggest percentage jump. R&D expenses hit $2.6 million.
$2.6 million.
From what, last year?
From only $0.9 million in Q1 2024.
That's a huge increase. What's driving that?
It reflects investment in product innovation, especially work on their Transdermal Infusion system, the TDI.
Ah, the PDI. Okay.
Yeah.
Also includes some lobbying efforts around reimbursement policies and other general product enhancements. Now, while $2.6 million was high for Q1...
We'd expect that to come down too.
A bit, yes. They guided to an R&D run rate of around $1.5 million per quarter for the rest of 2025.
$1.5 million. So still significantly higher than last year's average rate.
Oh, absolutely. Last year, the average quarterly R&D was closer to $500,000. So $1.5 million per quarter is a real step up, signaling a higher ongoing commitment to R&D.
Okay, so Q1 definitely looks like an investment quarter across the board. How did all this spending leave their balance sheet? Do they have the cash to keep this up?
Seems like it. They ended the quarter in a pretty strong position, actually. $19.1 million in cash on hand.
MDET.
Zero debt. None.
Nice.
And they also mentioned having $9.9 million worth of inventory ready to ship.
Which is important if they're expecting demand to pick up.
Exactly. Both for traditional sales and, perhaps more importantly, for placements under this new program they're pushing, the Fair Deal Agreement Program.
Right, the FDA program. You mentioned this earlier as a potential business model shift. Let's unpack that. What is it and why is it so significant?
So this program is really core to their story right now. It changes the whole economic model for these systems. Instead of just selling the machine up front.
The traditional way.
Right. The FDA program aligns Sensus Healthcare's money-making directly with how much the system is actually used by the practice to treat patients.
Ah, so volume-based. Patient volume and practice utilization.
Precisely. Think less like selling a product, more like providing a service where you get paid based on usage.
Yeah.
It gives Sensus predictable, recurring revenue streams.
That is a fundamental shift from one-time hardware sales. How's the rollout going? Are practices signing up?
They gave some early numbers. They initiated 11 agreements so far, and 6 of those actually went live, started generating revenue in Q1.
6 live in Q1. Okay. Any data on how those initial sites are performing?
Yes, and this was a metric they really highlighted. Patient treatments from those existing FDA installations. They increased by 65% in Q1 compared to Q4 of last year.
Wait, 65%? Quarter-over-quarter increase in treatments just from those first few sites.
That's what they reported, 65%. Management is pointing to this as strong evidence that the model works, that utilization really drives the economics and can lead to significant recurring revenue.
That's a strong early signal if it holds up. What's the lag time here from signing a deal to actually seeing cash flow?
They clarified that it's typically about 4 to 5 months.
4 to 5 months from signing.
Or installation.
From signing the agreement. That covers getting the paperwork sorted, installing the system, getting the practice trained, and starting to schedule patients, plus the time it takes for insurance payments to come through after treatments. So there's a lead time.
Okay, 4 to 5 months from signing to first revenue. So based on that, when do they expect this FDA program to start making a real dent in their overall revenue?
They're anticipating significant contributions starting in the second half of 2025, so Q3 and Q4.
Makes sense given the ramp-up time. Are they expecting to sign more of these deals soon? Yes. They guided that they expect to sign another 3 to 5 additional multi-site FDA customers during 2025.
Multi-site customers, so potentially larger practices or groups.
Exactly, which could represent pretty substantial future growth potential given the scale involved.
And are they just placing the systems and hoping for the best, or are they helping these practices drive that utilization?
They mentioned they're actively helping, providing specific marketing support, sharing data insights with these FDA customers.
To help them find patients and fill the schedule.
Precisely. They said they're starting with the large private equity-backed groups, but the goal is clearly to help build patient volume because under this model, when the practice wins, Sensus wins too.
Right, their interests are aligned. Okay, so FDA program is key. What about their traditional business, selling systems outright?
It's still happening. They shipped 21 SRT systems under the traditional model in Q1.
Okay, and where does that put their total installed base?
That brings the total to over 880 systems, not counting the FDA ones.
Over 880. Do they have targets for that?
They do. They're aiming to get past 900 systems by the end of this quarter, Q2. And then hit the 1,000 unit milestone for direct sales within the next 12 months.
So still growing the traditional base alongside the FDA push. Now, product innovation. You mentioned the TDI, the Transdermal Infusion system. Any updates there? That's been talked about for a while.
Yes, they provided an update. They said enhancements are underway for the system. And importantly, they resubmitted their 510K application to the FDA.
Resubmitted in Q1.
Early March,
yeah.
They said. And the 510K, just for context, that's the standard regulatory path they need to get clearance from the FDA to actually market and sell the TDI in the U.S.
Right. So what's the timeline look like for the FDA's decision on that resubmission?
Well, the typical FDA review cycle for these is roughly 6 to 9 months.
Okay, 6 to 9 months from early March. So sometime before the end of this year.
That's what they're expecting, yes. A determination before year-end 2025.
How did they sound about the submission? Confident, cautious?
They sounded, I'd say, comfortable. They expressed confidence in the package they submitted, and they made a point of specifically noting something interesting.
Which was?
As of the call date, which was May 15th, They had not received any follow-up questions from the FDA on the submission.
No questions yet. Is that significant? What do people usually read into that?
Well, it's tricky to say for sure. But generally, not getting immediate questions can sometimes suggest the FDA found the initial submission fairly complete or straightforward.
So maybe a smoother review doesn't guarantee anything, obviously.
Exactly. It doesn't guarantee approval, doesn't guarantee it'll be faster, but it's certainly viewed as better than getting a long list of questions right out of the gate, which can cause major delays. Management sounded optimistic about the TDI's prospects once approved.
Okay, potential catalyst there before year end. Let's shift gears slightly. How are they getting the word out? Market presence, customer outreach.
They talked about hitting the big industry events hard. Mentioned Winter Clinical in Maui, the big American Academy of Dermatology annual meeting.
AAD, yeah.
Right. They even mentioned hosting a dinner event at AD with the swimmer Katie Ledecky, which was apparently packed. So generating buzz.
That's one way to do it. What about reaching practices maybe outside those big national conferences?
Yeah.
The smaller guys.
They actually emphasized that too. Talked about the value of smaller, regional, sort of grassroots meetings.
Going local.
Yeah. They see those as really important for connecting with practices that might not travel to the huge shows. And crucially, they said these smaller meetings are generating a strong pipeline for the FDA program.
Interesting. So reaching potentially different types of practices that way.
Including, they noted, some smaller practices that still have high patient volumes, maybe in areas that are a bit underserved by the bigger players.
Got it. Any international focus mentioned?
A little bit. They attended the ESTRO show in Vienna. That's a European radiotherapy conference. And they mentioned they'll be exhibiting soon at the Australian Academy of Dermatology meeting.
Australia. High skin cancer rates there, right?
Exactly what they pointed out, a key market opportunity for their technology. Okay, so let's pull this all together. We've got the Q1 results, lower revenue, net loss, but driven by higher strategic spending. How does management connect this to the rest of the year? What's the outlook?
Their core message was crystal clear. Q1 was the investment period. The pain, if you will, was planned.
A necessary step.
A necessary step, they argued, to position the company for a return to profitable growth, driven primarily by that FDA program ramping up and hopefully the TDI approval.
And did they give specific guidance for the rest of 2025?
They did, and it was quite bullish, actually. They expect to return to profitability in each of the remaining 3 quarters.
Q2, Q3, and Q4.
Yes, and therefore to be profitable for the full year 2025.
Okay, and revenue expectations.
They anticipate Q2 revenue will be higher than Q1, and then importantly, revenue in the second half of the year, H2, is expected to be significantly higher than the first half.
Driven mainly by that FDA program kicking in.
That's the primary driver they highlighted for that H2 acceleration, yes. The Q&A sessions on these calls can be revealing. Did anything come up there that added more color or reinforced these points?
Yeah, a few things. They definitely doubled down on the outlook.
Yeah.
Confirmed they expect the remaining quarters to be stronger and profitable, not just versus Q1 25, but potentially even stronger than the same quarters back in 2024.
So growth versus last year too, potentially?
Potentially, yes. They reiterated the FDA program revenue should become meaningful, their word, starting in H2.
Okay. Anything else notable from Q&A?
Let's see. They confirmed U.S. tariff policies haven't really impacted their business so far. They reclarified that 4 to 5 month timeline, stressing it's from signing the agreement to first revenue, not just installation, emphasizing that whole ramp-up process.
And what about that 65% treatment volume increase at the early FDA sites? Any more detail on that?
They really hammered home that patient volume after the system is in place is the absolute key. They see that 65% jump as significant organic growth, validating the model's potential.
Not just placing boxes, but driving usage.
Exactly. They also talked a bit about how their analytics team helps customers pinpoint the best, highest volume potential sites for these FDA placements. And apparently, those data-driven picks often match where the big groups were already thinking of deploying first.
Interesting synergy there.
Yeah. And they mentioned the payment cycle for treatments is usually around 45, 60 days.
Good detail. Did they talk about the potential scale of these multi-site deals?
They did. Hinted that these large groups might initially identify, say, 10 to 20 or even more high-volume sites right off the bat.
Wow.
With the potential for even more installations within that group over time. So really trying to paint a picture of how significant this shift could be if it scales.
Right, moving from single unit sales to potentially dozens per customer over time.
Correct. Oh, and they gave a quick nod to May being Skin Cancer Awareness Month, just tying it back to their mission and the market need.
Okay, that paints a very comprehensive picture of the call. Before we wrap, let's do our This Is Not Financial Advice segment. Taking everything we just discussed from the call purely as a thought experiment.
Yeah.
How might someone, say, an analyst pitching an idea, frame a potential trade? An outrageous but plausible one based only on this call.
Okay, purely hypothetical high-risk thought experiment. Here goes.
Let's hear it. Remember, not advice.
Absolutely not advice. So you look at the setup. Management guides for profitability in every quarter from here on out and for the full year, explicitly calling Q1 the investment trough. They've got cash, no debt runway. The FDA program shows this huge 65% sequential jump in treatment volume at early sites, and they expect meaningful revenue from it starting next half.
Okay.
And the TDI 510K was resubmitted in March, decision expected by year-end, with this little nugget about no follow-up questions yet, potentially hinting at a smoother, maybe even faster review.
So where's the trade idea in that?
The idea, the outrageous part, is a leveraged bet that this positive inflection point, the shift from Q1 loss to H2 growth, happens faster or stronger than the market, which just saw the loss, currently anticipates.
How would you structure that hypothetically?
It could involve something like buying out of the money call options, maybe expiring around Q3 earnings or perhaps year-end to capture the potential TDI news.
Betting on what specifically?
Betting the market is underestimating one of two things. Either the speed and scale of that recurring revenue ramp from the FDA program in H2, fueled by that 65% volume growth signal, or the possibility of a positive TDI decision landing earlier in that 6-9 month window, perhaps nudged by the no questions comment.
So an execution bet or a regulatory bet, essentially.
Pretty much. The cash position lowers the immediate blow-up risk, but it's still a high-risk bet on management executing flawlessly on the FDA ramp, or getting a timely regulatory win, or both, causing a sharp re-rating, purely connecting docs from the call's narrative. Highly risky.
Definitely sounds high risk, relies on a lot going right, but a fascinating exercise in how you can read between the lines on these calls.
It's about identifying potential catalysts the market might be discounting. Just a thought experiment.
Understood. Okay, let's quickly recap this deep dive then. Sensus Healthcare's Q1 2025, lower revenue, net loss. But management says this was planned strategic investment.
Setting the stage, they argue, for profitable growth ahead.
Driven especially by that Fair Deal Agreement program, which showed that really strong early treatment volume growth.
The 65% number, yeah.
Yeah.
And also by expected progress on their TDI systems FDA review.
And the outlook is key. They're guiding for profitability starting now in Q2 and for every quarter this year, with a significantly stronger second half fueled by that FDA ramp.
The potential move to recurring revenue seems absolute central to where they want to take the company.
Which brings us to our final provocative thought for you, the listener. Consider this. How truly transformative could this shift to recurring revenue via the FDA program be for Sensus Healthcare's business model and maybe its long-term valuation compared to just selling machines? Is that 65% volume increase a real sign of its potential or just early days noise?
Or, on the other side, how much is a potential TDI approval already baked into expectations? And what does no follow-up questions yet really signal about the FDA timeline or outcome? Could it be faster, or is it just wishful thinking?
Questions that, as you said, will definitely keep people watching the next few quarters very closely.
Indeed.
All right, that wraps up our deep dive into the Sensus Healthcare Q1 2025 earnings call. We hope this breakdown gave you the clear insights you need.